to our third episode of the Financial Pathway, an episode where we will be looking at investing. I am Brandon Hovey, and as always, I'm joined by Tim Hedberg. Both of us serve as financial services representatives with Covenant Trust and help women and men plan for retirement, invest well, and craft smart estate plans. Today, we have a special guest with us all the way from Chicago. Drake Petersen serves as a portfolio manager at Covenant Trust. He knows a lot about investing, a lot about how to do that well. So we're excited to have him with us, and I trust that you'll learn quite a bit. So Drake, thanks for joining us.
Oh, thanks for having me, Brandon. It's a pleasure.
Well, today we want to talk about investing, but before we do, I want to remind us and give us a brief overview of the financial pathway. And so here on the screen, you'll see the financial pathway. It's a bird's eye view of personal finances. And we talk about the spending plan, investment plan, retirement plan, and giving plan, kind of the nuts and bolts of a smart personal finance plan. But what really makes this model unique and different from some of the other ones you might see is we also talk about aligning our values, our purpose, mission, and call with our plan. And so we want to make sure all of these things are in alignment and are informed by our money story, which is how we view money based on how we were raised and different habits we've picked up along the way. And so far, we've talked about creating a spending plan, creating a budget. We've talked about credit, making sure we have a good credit score. And we've also talked about how to manage debt. And if you've done these things, if you've tracked with us so far, it's time to get to the fun part, to investing money and making it grow. And so that's what we're going to talk about today. And for the first question, I'm going to hand the mic over to my colleague, Tim.
Yeah, thanks, Brendan. Drake, I'd like to start by talking about some of the misconceptions when it comes to investing. And these cartoons can show us two of the ways that people often think about investing. You'll notice on the one in the left side, there's a man talking to his therapist, and he's kind of comparing gambling to investing. And a lot of people do this. They think investing is like going to Vegas and hoping for the best. And this can lead people to being very risk adverse. Like we see in the second cartoon, the man hiding behind the couch. People like this want to eliminate all kinds of risk, and they end up investing nothing in the markets and thinking that's the safest thing to do. So, Drake, with these misconceptions, can you speak about the misconceptions that you see from your vantage point?
Yeah, sure. This gambling misconception is based on the idea that you need to be cunning or lucky to beat out others to cut it as an investor, and that investing is a zero-sum game that requires one person to lose for every one person who wins. And that is largely untrue. With investing, the odds are usually weighted in the investor's favor. There are exceptions to this that are more like gambling. I would call that speculation, but it is really important to separate speculation from investing, which is what we're talking about here today.
Yeah, so can you dig a little bit deeper with that? What does separate investing from speculating?
Sure. So real investing is basically deploying your excess money or your savings in capital markets where companies will pay you to use those funds for their business. And your compensation as an investor comes back in the form of profits that company earns. So you're not guaranteed to make money in every span of time with every company you invest in. But historically, that entire process is generally profitable for investors that are patient. Because it is generally profitable for investors over the long run, gambling isn't a good metaphor. The best metaphor I can come up with for what investing is would be someone, say, renting out a home. Maybe it's too literal to use as a metaphor because being a landlord is a type of investment. But I think it's the easiest investment to visualize. In other types of investments, instead of being a homeowner, lending out your home to renters, you have these assets that you have accumulated through savings, and you're going to rent out those assets to companies, and they are going to pay you for using those assets, much like a renter would pay rent. And to demonstrate the profitability of this for investors, we have a chart here that since 1926, US large cap stocks have returned 10.2% per year for their investors. So $1 invested in 1926 is almost $9,000 today. And just avoiding some common pitfalls can help you participate in that growth without needing to outsmart anybody.
Thanks, Drake. One of the things Tim was mentioning was this idea of being fearful of risks. And I think this is a natural thing for many people. I know when I was younger, I took a lot of risk. I used to do cliff jumping and extreme skateboarding. But now that I'm a little older, I'm a little bit more risk adverse. I don't really want to break my arm or lose my life savings in the stock market. So for somebody who is more risk adverse and tempted maybe to keep all their money under their mattress or in a savings account, what kind of advice would you have for them?
I consider risk to be the most important concept to wrap your head around in investing. Broadly, I define it as the chance of a certain investment or a portfolio having an unfavorable outcome that does not meet your objectives. And that unfavorable outcome can be caused by a variety of risk sources. As I see it, risks can be placed into two broad categories. You have planning risk and you have investment risk. You mentioned the idea of someone keeping their investments in a savings account as a type of risk. First, this sounds like a case where someone has not thought about their objectives and don't really have realistic expectations, because rarely can someone expect to fund their retirement with only cash savings and no investment earnings over time. So for most people, this introduces a type of planning risk called longevity risk, or the risk of outliving your investments. Their lack of an investment plan has possibly introduced this longevity risk because this individual will outlive their assets.
So planning risks are something that is very important to address. This is why Tim and I often will create smart financial plans for clients. We want to mitigate investment risk, which is part of developing that plan. And many people we talk to have investment risks right off the bat. For example, they have a heavy concentration in one or two stocks. Maybe they had stock options in a company many years back. So this is something that is front and center for a lot of people out there. So can you maybe explain a little bit more about investment risks and why it's important to be aware of them?
Sure. Investment risks are introduced into your portfolio by the investments that you decide to purchase. One of the worst potential outcomes for an investment would be permanent loss of capital through a company going bankrupt, for example. That is called company-specific risk. You then have all these additional sources of risk, like industry risk, where entire industries can suffer at the same time, such as what we're seeing with energy or retail stocks today. Inflation, interest rates, politics, et cetera, can all add risk to the portfolio as well. But if you have a good financial plan, you can mitigate risk. And fortunately, almost everything listed on the right side of this page can be practically eliminated through what is called diversification, or colloquially, not putting your eggs in one basket. So company-specific risk, for example, can be eliminated by investing in many companies instead of a few, such that the failure of one of those companies does not cause your entire investment portfolio to fail. A recent example of company-specific risk would be Boeing and their 737 MAX ordeal that's been in the news. That type of risk could be diversified. In the same way, you can invest across industries and countries and currencies in a diversified manner to all but eliminate those sources of risk. And once you diversify all Once you diversify away all the risks that can be diversified, you will be left with what's called market risk. And this is the risk that impacts the entire market or the financial system as a whole and can't be diversified away. This type of risk is easily observed in a time like today. The COVID-19 crisis impacted most of the market and global financial system all at once. And if you had a diversified portfolio, it would have been impacted negatively by these events. And how much it's impacted in terms of how much prices fluctuate, that's your market risk. And nobody likes market risk, but it's unfortunately unavoidable. And it's theoretically why investors are compensated for lending out their savings and investing. Fortunately, you can control the degree of market risk you're exposed to through your asset allocation. If you want to expose yourself to less market risk, you can allocate more of your portfolio to lower risk assets like bonds, or you could add market risk to your portfolio by adding riskier assets like stock, for example.
Mm. Yeah, that's good. And I think one thing that has been helpful for me to understand is that risk is unavoidable, right? So even and we're talking about investing, even if we put all of our money in savings, the inflation rate could to go up higher than the interest rate that we're getting on our savings account. We'd thereby be losing money. So risk is unavoidable. The big question is, what's the proper amount of risk each person should take? And how does that relate to their long-term plan? And so this is where kind of building the right portfolio comes into play. All investors need to find the sweet spot between having the right mixture of stocks and bonds. So sometimes it's helpful to think about it as a car, right? So in a car, stocks are kind of like your accelerator. They help propel your portfolio forward and give you larger gains during good markets. And then bonds are kind of like your airbag, and they can lower risk and they can protect you against certain kinds of market downturns. So we need both. We need stocks, we need bonds, and we need probably people like you on our team to make sure that we're getting that mixture right, that we're achieving that diversification you're talking about. But talk to us a little bit more about this idea of stocks and bonds and why we need kind of the right mixture of both of these.
Sure. Well, what you're saying is absolutely right. A critical concept in investing is that market risk and expected portfolio returns are related. Otherwise, why would someone invest in anything except the lowest risk bonds? Nobody likes risk, so investors generally require more returns over time to compensate them for that extra risk. The more market risk you take on, the higher returns you can achieve. And this relates to stocks and bonds because the allocation between stocks and bonds is the easiest way for someone to adjust the market risk in their portfolio. Bonds generally have less market risk because the income paid to you is typically guaranteed by the company that issued the bond. Stocks have more market risk because stockholders are going to be the first investors to absorb the losses that a company has during a market downturn. You can see this relationship if you chart the long-term investment returns and market risk of various portfolios with different allocations between stocks and bonds, which we're doing in this slide for you here. It is common in the industry to represent market risk through price fluctuations or volatility. So you can see at the bottom of this chart, those volatility measurements. And as you add stocks to your portfolio, your returns generally move up this chart, but your risk or price fluctuations also increase by moving to the right. You will notice a bend in the bottom of this chart as well. And this can be interpreted as adding stocks to an all bond portfolio actually reduces risks while improving returns. That is because stocks mitigate some other risks we discussed earlier, like inflation and interest rate risk. But after adding enough stocks, that kind of benefit and risk mitigation is overwhelmed by the additional market risk. being added to your portfolio.
Thanks, Drake. This is helpful. How does this strategy work in a time like this? It's August of 2020 when we're having this conversation, and the coronavirus is on our minds and in our world. And consequently, there have been ups and downs in the market, and some investors are leery of jumping in, saying there's way too much risk, and other people are doing just the opposite. They see the markets as being on sale. So how should investors think about all this? Should we be investing now?
Well, that up and down fluctuation in prices we're seeing right now is the market risk that we're talking about. It's certainly challenging while it's happening, but it isn't unexpected. A diversified portfolio is behaving now how you would expect. Portfolios that have more market risk have declined more than those with less market risk. So, for example, if you were invested in the lowest risk allocation on the chart we were looking at earlier, that was 33% equity or stocks and 67% bonds, that portfolio would have declined 9.8% through the March 23rd market bottom. The highest risk portfolio, made up entirely of global equities, declined really significant 31.8%. But that doesn't mean that this longer term relationship between risk and return in a diversified portfolio won't continue to hold. We've also already seen a significant stock recovery, global stocks being up 45% from the bottom on March 23rd, while that lower risk portfolio has only gained 19% from that time. So we would advise that you consider investing today like you would at any other time. Take control of what you can control, which is the level of market risk that you're exposed to in your portfolio. It's how well you have mitigated other risks through diversification, and it is how much you're saving or spending. You can't control the returns delivered by the market or the economy, but that risk and return trade-off will very likely continue to hold over the long run.
Yeah, thank you, Drake. One final question. Let's say some of our listeners have an emergency fund in place. They have their spending and budget in place. They've gotten their debt stuff figured out, but they haven't started investing yet. They see the value of investing. They understand a lot of the things we're talking about, realizing that they're going to need to invest for retirement, to reach some savings goals, and to bless people or charities in their community. Where might they begin? How do we get in? Where's a good place to start?
Start by selecting where you will invest. For those who like to handle these kind of matters themselves, a brokerage or a mutual fund account would be your best option. The barriers to entry for doing your investing on your own is very low these days. Also, see what investments are offered through your company's 401k or 403b if you work for a nonprofit. For those who would like some help in the area of investments, registered investment advisor or Covenant Trust are options as well. The next step is defining your objectives and your tolerance for price fluctuations, that market risk we were talking about earlier. Finally, identify the mix of assets that meets those goals and your tolerance. And I realize that that's a lot to put in one step, but we're also running up on time here, and that probably needs to be a future expanded discussion. Just recall that the risk and return trade-off is best managed between your stock and bond allocation. And remember to broadly diversify to mitigate risk by investing across countries, companies, industries, and different asset classes. And my last advice is to think about your asset allocation as a long-term plan, just like the other parts of your financial plan. it shouldn't be changing drastically on a frequent basis, because that quickly turns into a speculative gamble like we talked about earlier.
Wow, thanks, Drake. You've given us a lot of good content here and a lot of things to think through and then act on, hopefully. So as we wrap up, we just want to close with some ideas that you might take as some next steps. The first is you can meet with a person like myself, Tim, or Brandon. There are Covenant Trust representatives around the country, and we'd be happy to have a specific conversation with you about the questions and interest you have in investing. Secondly, Drake has a great video on staying invested, staying in during times of fluctuation and times where things aren't so up and down. So that's on our YouTube channel. And thirdly, if you're interested in getting going in investing, you can open up an investment management account with Covenant Trust, and Drake and his team would be the folks that would ensure that that money was invested well and according to the objectives that you have. So thank you for joining us. Drake, thank you for joining us today, being our guest. And in our next episode, a colleague of Brandon and mine named Ingrid will be talking to us about retirement. So thank you for listening and have a blessed day.